There are two main categories of documents in a commercial lending deal: the principal or primary deal documents and the ancillary documents. The principal documents contain the major economic and legal terms of the deal. So this would include the credit agreement, guarantee, security agreement, and sometimes even an intercreditor agreement or a subordination agreement. The ancillary documents are everything else. Even though they don't include the main deal terms, and often aren't even formal agreements, they're still important to how a loan functions. Ancillary documents can be grouped together into categories. There are corporate certificates, legal opinions, form documents, and documents related to collateral. Corporate certificates and legal opinions are used in all lending transactions. We'll talk more about those later. Form documents are also used in most deals, but the number and type varies. Common form documents are things like promissory notes, assignment and assumption agreements, and borrowing notices. These are the documents prepared prior to closing but used as needed at closing and throughout the life of the loan. They're usually attached as exhibits to the credit agreement. And documents related to collateral are only used, not surprisingly, if the deal is secured. Depending on the assets being pledged, this could include things like deposit account control agreements, or DACAs, IP security agreements, or similar agreements that get filed with the U.S. Copyright Office or the U.S. Patent and Trademark Office, landlord waivers, where the borrower's landlord acknowledges that the secured party has a lien on collateral that the borrower keeps at the leased property. These waivers also confirm that if an event of default occurs under the credit agreement, the secured party can enter the property without the landlord's further consent. And insurance certificates and endorsements. These are standard forms delivered by the borrower's and guarantor's insurance company or their insurance broker. Insurance certificates provide a summary of the policies, showing that the debtor, its business, and the collateral are adequately insured. Sometimes insurance certificates are also required in unsecured loans, though that's not typical. Insurance endorsements add the lender or the agent to the insurance policies as an insured party or a loss payee. As an insured party, the lender can enforce the policy, and as a loss payee, if any of the collateral suffers a total loss, then the lender has the right to receive insurance payouts directly. In general, ancillary documents aren't heavily negotiated. Those that are usually involve negotiation with a third party, like with a landlord waiver, where the landlord might want an indemnity from the secured party for any related damages to the property, and the third party typically has a lot of leverage, since the secured party usually isn't in a position to ask the borrower to move its lease.